Another day, another stock review. Today, we go back to the solar industry with Enphase Energy, ticker symbol ENPH. This company creates semiconductor materials and equipment, and its current market cap is $16.93 billion. Moving on over to the company's website, I wanted to quickly show off the company's purpose and values. If we scroll down, we can see that their main purpose is advancing a sustainable future for all. They were founded in 2006, and their whole goal is to transform the solar industry with their revolutionary microinverter technology. Enphase combines their microinverters along with their smart battery technology in order to create one of the industry's best performing clean energy systems. Their claim to fame is efficiency and making things work their best. Switching on over to their most recent investor report, we can see that Enphase is a leading energy technology company who has partnered with over 1,500 installers in their Enphase installer network as of June 30th, 2023. Enphase's equipment largely goes into solar panels that are used on top of buildings and in residential or in commercial applications. And we can see that they've shipped approximately 68 million microconverters since the company has been established, which are working in a total of 3.5 million systems in more than 145 countries around the world. What makes Enphase different from other microconverters out there is that they integrate their converter with semiconductors that allow for predictive control. This, partnered with their software-defined architecture, creates an incredibly efficient and customizable solar panel system. The company does have a very well-designed business model. They're going for the CapEx light approach, meaning they do not have many big factories, and they rely more on other companies to do the major production for them. Enphase prefers to specialize in a few critical parts in order to make themselves the best supplier of those parts in the industry. The company also focuses heavily on their operating expenditures and making them as efficient as possible. We can see in this map here below that their headcount, 51% of their employees are in India. What is unique about India is that it's a very highly educated society and country, but they work at much lower prices than people in the United States or Europe or Australia and New Zealand work for. And so that is how Enphase is able to keep such low operating costs, is by employing people who are very well qualified, but in places around the world that cost the company much less to employ these people. Enphase also has a very global supply chain with manufacturing sites spread out across Mexico, a couple in the United States, Romania, India, and China, as well as distribution centers in China, Europe, the United States, and Australia. This is incredibly helpful and good to see, because in the world that we're heading to, where things are potentially getting more difficult to ship, there's potentially more tariffs and things like that. A globally diverse supply chain means that there's hopefully going to be less disruptions for the company in the future if something was to go wrong in one location in the world. This slide gives a great overview of the direction that Enphase is heading and how they want to be incorporated in many different parts of the solar system and the local energy supply chain. The company does not currently produce all of these things on a large scale, but they have plans for several of these. And if you want to, you can go to the investor presentation and see more details about their different products, including the microinverter, their EV charger, their batteries and control systems, and much more. And finally, before we talk about news for the company, I wanted to show this slide because for me, it says that Enphase is focusing really heavily on making as much money as possible from each solar installation. So we can see on the far left that in 2019, Enphase really only sold microinverters, and that would lead to an approximate revenue of $2,000 per home installed. In 2021, Enphase added batteries to that system, and so it could lead to a potential revenue of $9,000 per home, which is more than 4 times higher than where they were. And in 2022 and beyond, they're focusing not only on microinverters and batteries, but also on load controllers, EV chargers, fuel cells, their grid service software, etc., leading to a potential per home of $12,000 or maybe more, meaning that in just 3 years, the company has 6x'd its maximum revenue potential per home. But as I'm sure you are aware if you're watching this video, Enphase Energy is currently not performing too well in the stock market. Much of the company's recent problems are a result of 2 major issues. Number 1 is that the company has lowered its revenue forecasts. If we scroll down, we can see that solar equipment demand has been rather tepid in the United States, especially in states such as Texas and Arizona, where their cheap electricity prices make the economics of switching to solar far less attractive. This has led the company to lower its forecast for revenue to between $550 million and $600 million for its most recent quarter, compared to analysts' previous estimates of $746.5 million. What's worse is that some analysts are expecting a major slowdown in the US market to continue into next year, and they forecast that US inverter shipments are going to decline by 25% year over year in this fourth quarter and 28% in the first quarter of 2024. This is really bad news for Enphase and all other companies in the industry. The second major headwind for Enphase is the higher for longer interest rates. This video on Morningstar is not directly related to Enphase, and I'm going to have to apologize to Susan Dubinsky for pausing the video here on that face. Susan, I'm sorry. But the major issue with higher interest rates is that it ups the cost for financing for solar. And so because the cost of solar energy is entirely upfront, that leads most customers to finance their solar purchases. With higher for longer interest rates, that means that the financing for those purchases is going to be at a higher interest rate itself, meaning customers are paying a higher monthly payment in order to install their solar system. Because solar is so expensive for people to install, they are quite sensitive to changes in interest rates because a 1% increase in their financing costs might mean they can no longer afford to install their systems at all. So that hopefully got you caught up on what Enphase is, what they do, and some of the issues they're facing. Let's take a look at their financial numbers and see if this is a good company to invest in. Revenue growth has been exceptional at over 72% per year, which is not something you see every day. The company's EBITDA growth has grown at over 155% per year since 2018. Enphase's operating earnings have also grown very, very well, but I would like to point out that the company did not earn an operating profit in 2018, and then from 2019 to 2021, the operating profit was relatively stable, around $1 per share. It wasn't until the ultra low interest rates of 2022 that we saw this major explosion in operating earnings, which makes me pause and wonder if these current operating earnings numbers are sustainable for Enphase. The company's gross margins have generally been improving over time, which is great to see, going from about 30% in 2018 to about 44% in the trailing 12 months. Operating margins have improved as well and have generally hovered from the mid to high teens up into the low 20%. Enphase's return on assets has been a little more touch and go, but it is trending in the right direction and is currently sitting at approximately 16.5% for the trailing 12 months. Since 2018, Enphase has issued a lot of new shares, but they have started buying back those shares in the last year, and the company does plan to continue to buy back shares in the future. The company's cash and short-term investments have exploded along with their revenue and earnings, which is especially nice to see considering the company is dealing with a very uncertain market currently. Enphase's long-term debt has jumped quite a bit in the last 5 years, but I would like to point out that the total amount of debt on their balance sheet does currently sit at less than their total cash and short-term investments. We can see in this chart that higher interest rates have at least had a positive effect on Enphase's net interest expense, going from negative but certainly manageable to actually being positive in the trailing 12 months. Enphase's levered free cash flow is also expanding very rapidly, which is really nice to see, especially when you compare them to competitors in the industry. I don't have much else to add here. Free cash flow on a per share basis also looks excellent. And so finally at the value chart, we can see that Enphase has had some truly explosive price growth, and the stock currently looks to be fairly valued. I do want to point out though that its fair value PE is almost 45, and that's based on the previous 5 years of growth. But the company's current projected growth is only 36% per year for the next 5 years. Don't get me wrong, that's still an excellent number, but I think at the very least, the fair value PE should be updated to match that. So if I update the fair value PE to 36, we can see that Enphase's margin of safety does become much less, but it does still appear to look to have a little bit of margin of safety, at least for the last 12 months earnings. The company's current PE is 28.5. And its PEG ratio is 0.78, which is excellent, and it means that the stock price could seriously appreciate in value from today's price if the company is able to grow at the rates that are currently predicted. And that is my biggest warning with this chart. Currently, Enphase is expected to grow at over 36% per year, but we just saw that the solar inverter market is not doing well currently. And if economic issues continue to persist, we could see a flat or negative year of growth. That is entirely possible, and when a company like Enphase, which is so heavily valued on its future growth, posts a negative or even flat quarter or year, you could potentially see the stock absolutely plummet. That is not me predicting that Enphase's stock price is going to drop. All I am saying is that the stock's current price is heavily predicated on its future growth. And if that future growth does not occur, or it occurs much later in time, we could really see the stock struggle for a period of time. So for my final thoughts, what I really like about Enphase is that, of course, there's the secular tailwinds for the solar industry. It's a very young industry, and it's expected to grow very quickly. So I like Enphase's position to benefit from that. Number two, free cash flow remains really strong. If you compare this to other semiconductor companies or other companies in the solar industry, a lot of these companies right now are currently struggling to maintain steady free cash flow. I think it really speaks to Enphase as a company and to its leadership and their plan that Enphase is able to not only keep free cash flow coming, but to increase it over this time period. And finally, I like that the solar inverter industry, at least in the Western countries, is basically a duopoly between Enphase and SolarEdge. Anytime you have a duopoly, typically both companies do very well. And so I think the only issue that Enphase is going to have is any industry related problems. The company certainly seems to be in a better position than SolarEdge does. And if you're curious about learning more about SolarEdge, I do have a video that analyzes that company as well. What I don't like is their lowered guidance and the muted industry expectations for solar as a whole. This leads into my second dislike, which is that solar and semiconductor production are highly cyclical businesses. There are ebbs and flows in the energy industry, just like there are ebbs and flows in the technology industry. And to combine those together makes for a very, very cyclical company that is very exposed to industry risks that are out of its control. And finally, as I've mentioned several times, I also don't like that the company's current stock price is heavily reliant on its future growth, but I don't think I need to explain my thoughts on that again. So that is all I have for today. For me personally, I do not think I'm going to buy Enphase right now, but I am definitely going to keep it on a watch list and hope that the company continues to struggle for another quarter or two and that Wall Street gets really sick and tired of lowered guidance and lower than expected numbers. I do think that Enphase is going to benefit tremendously in the future. And in this case, I think near-term headwinds would be preferable for me so I could get a better entry price that isn't so predicated on future growth. So that is all I have. I hope you guys enjoyed this analysis. If you do have any ideas of other stocks you'd like to analyze, please leave a comment down below. Otherwise, let me know your thoughts on Enphase, and I hope you guys have a great day. Bye.